Welcome and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. As we think about investing our money for our long-term range goals and plans, especially when it comes to possibilities of security and retirement, we try to find the best way that we can make our money grow. Most of us, though, when it comes to investing money, think it's rather a dry subject and don't really do a whole lot of homework when it comes to finding out what the best way is to get our money to grow. A lot of us always talk about those neat stories when we wished we could have gotten into things such as Intel, Microsoft, and Apple Computer, that if we had just gotten in at the right time, we would probably be filthy stinking rich by now. Joining us here on the Beyond 50 radio program today is author of the book called Odds On. It's the making of an evidence-based investor. He shares his story with us here and talks about how he can have long-term success for you in their favor by combining a long-term plan with evidence-based investment tools and behavior management. Our guest has also led trainings for other top wealth managers, created new evidence-based mutual funds, and started an online book group of like-minded advisors from around the world. This is his very first book, and I'd like to welcome to the Beyond 50 radio program today our guest, Mr. Matt Hall. Matt, thank you for joining us here on the Beyond 50 radio program.
Hey, thank you so much with that introduction. I don't know that you need me. That was pretty good.
Well, you know, you're out there, and the funny thing about this is you're so right about what you talk about in this book, and the first thing I think of is for those of our listeners out there who have watched the movie The Wolf of Wall Street, I remember the very beginning where Matt McConaughey is actually bringing him into the business, and they're sitting there and they're having that lunch, and he says, look, the idea is that you get them in, and then you bring in the next idea and you move them over to that because it's about us making real money, which is the commissions. So a lot of times when people have that approach, they're not really looking at the investor's best interest, are they?
No, that's right. And I have to mention, I love that you just referenced that clip from that particular movie. In my office, we have that clip, the audio portion anyway, saved as a reminder that, you know, that's not fiction. That's reality for a lot of people. That the financial services industry or the brokerage industry isn't necessarily working in their best interest. As you may know right now politically, there's a thing being discussed by the Department of Labor called the sort of fiduciary standard. And there are lots of professionals in this country who operate under that standard, which puts the client at the very top. But traditionally, most big banks and brokerage firms and trust companies don't have that same standard. And that particular clip from Wolf of Wall Street is, for some people, may feel like it's sort of like overdone, and in reality, it's probably not that far from the truth.
Well, you know, and again, as I was reading your book, it was funny because there were other movies. These movies, it's interesting because they show how sexy money can be. But generally, what you're not paying attention to, it's sexy for the person who's selling the product. For instance, the movie Boiler Room is one of those, the same thing. It's about getting people into that next big idea that's going to be explosive, you know, to where their money is going to go from $1 to $10,000. And you have to ask yourself, why do we have that kind of thinking when it comes to investing our money?
Yeah, I guess there's this notion that it would be really exciting and fun to hit it big and do it quickly. I mean, it's boring to say, hey, let's be patient, let's be sort of steady, disciplined, persistent savers, and the good things will happen. You know, there's a famous Buffett quote that says, someone's sitting in the shade today because someone planted a tree a long time ago. You know, that it takes time, patience, and discipline to sort of make long-term financial goals a reality. And in my experience, you know, it's not to say that someone couldn't get rich quickly, but it's certainly the exception and not the norm. And it takes extraordinary risk to make that happen, often entrepreneurial risk or business risk. And for most people who are working and saving, you know, I wake up every day thinking, how can we move the movement that I'm sort of a part of forward? Meaning, how can we get more people tuned into an evidence-based approach versus speculation? You know, back in the old days, meaning like in the 50s and 60s, if you said, how have the markets done? No one knew. They didn't have the data. You couldn't hold anyone accountable to the promises or the bets they were making, because no one knew what the markets had really done, what the averages were, what the historical averages were. So any kind of promise that or bet that any of us made, we weren't really held to a standard that said, well, how would we have done if we had just sort of bet on the whole thing? If we had just sort of owned an index fund or owned the world. Back in those days there was no accountability because there was no data. Now, today, that is not our problem. We have lots of data. We have lots of information. And the question really is, what do we do with it?
Now, you originally started out idealistically wanting to become a lawyer.
Mm-hmm.
Then you found yourself realizing, well, I don't think this is the route that I want to go, and you were supported by your father, your parents for the most part, as he pointed out, well, look, you always liked doing this. But then as you were starting to steep yourself into this particular world of investing and helping people to invest their money, you realized, geez, this really doesn't seem to be any better than the law direction I was going.
Right. No, you're right. And the book really has three distinct sections. In the beginning of Odds On, it talks about why I sort of became unhappy with what I found when I started poking around financial services as a business and what the industry looks like. When I saw sort of the underbelly of how investment firms worked, I didn't like what I saw. The second section of the book really is about what a potential solution might look like. I was lucky enough to rub up against some great mentors, some great people, and I share what I learned through that experience. The last part of the book is about my own journey and sort of crafting what I viewed as sort of an island of idealism. Well, that's what we called the firm that we started, which was kind of taking the best ideas we had learned from our experience and eliminating the worst. And so I just wanted to share my experience, and I have to tell you, Daniel, most of what I was trying to do was bury sort of the wonky technical stuff that normally turns people off when reading about finance and investing, bury it into life stories that would keep people tuned in just long enough to get injected with some of the same sort of data and evidence that I'm passionate about.
Now, I had the opportunity and took it a few years back to read the wonderful biography about Warren Buffett called The Snowball. Mm-hmm. And anybody that takes the opportunity to at least read that story, which was very, 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 very well written, you realize, I can really do this. And one of the things that really began to emerge, especially from his story, is something that I know that you talk about in your book, Odds On, is the first thing you really need to do is do your research and do your homework, but the matter is, how does one get started?
Mm-hmm. Yeah, well, obviously Warren Buffett is considered one of the great money people of all time anywhere in the world. And I would say getting started, one doesn't have to be Warren Buffett. Really you just have to have excess funds that you don't need to live off of, and then as you start saving, index funds are a great way to get started. There's a slightly more elegant version, I think, of what one can do beyond just index funds, and I detail a little bit of that in the book, but my objective is really to change someone's sort of world view. I use a couple comparisons in the book. One is, if you remember the book Moneyball or the movie Moneyball, what has taken place in baseball? Well, in baseball, scouts used to make decisions about the talented players they would draft or trade for based on, intuition. Now, every Major League Baseball team has a stat department, a group that is studying the data and the evidence to help their team figure out which players would be the best fit for their organization given their budgets and, the talent or the skill set that they need. Everyone now uses data and evidence and is very low on, intuition. Not to say that doesn't play some role. In the perfect world, it's really some hybrid of the two. But I think if investors get started, the thing that I'm most passionate about is if you can use the data or use the math to help give yourself the best chances of success, whether you have $10 or $10 million or $100 million, why not put the odds on your side? Why not choose a philosophy that gives you the greatest chance for success? So that's really why I wrote this book, was because whether you're starting out or whether you're hugely successful, And my firm, the firm that I own, we work with a lot of people who have been hugely successful. And if you ask them what their investment philosophy is or what their approach is, most people don't have one. Most people have chosen whoever they work with or whoever manages their money based on someone they know or their family has worked with in the past, but they don't really have an approach or a philosophy that's based on logic and data and evidence. Frankly, they don't even have transparency. If I ask people, what are your fees, what are your returns, what's your allocation, no one even knows those things. So if you're a beginning investor, what you want is a high level of transparency, low costs, and the best chance for success, which I think a good way to get started is via something simple like index funds. And I was going to mention to you also, there's a great book that was written by a guy who has a firm in the Pacific Northwest named Bill Schulteis. I don't know if that name rings a bell, but he wrote a book called The Coffee House Investor. I don't know how many years ago it came out. But it sort of espouses a very similar philosophy to Odds On. And he's a great guy, and that book has been a huge inspiration to me, and is a book I give out to a lot of investors just getting started.
Now, it's interesting because it seems to me that the financial services industry deliberately at times wants this to be very confusing, as you were talking about in your book, which I didn't see, is all the technical terms, percentages, graphs, a lot of stuff that really kind of turns people's heads where they'd rather be watching maybe an episode of Breaking Bad, for instance, rather than looking into this stuff a little further. But the fact is there are really some basic principles that as a person goes to start investing their money, that they just follow basic principles that you talk about, that they're already going to be ahead of the game. Now, tell us about a couple of those that people should be aware of.
Okay, so a good friend of mine who did the endorsement that's on the front of the book, his name's Carl Richards. He is known, if you go to the New York Times website and you look at he's called the Sketch Guy. He does sketches that combine money and emotion. I think he's one of the best people in the country at combining money and emotion in very simple ways. And Carl has done a fabulous job of helping people really understand one of the most basic concepts, which is called the behavior gap. And this is so simple, it's going to sound so easy, and yet it's hard for people to do. So what happens normally in the world of investing? Regular investors, what they do is they typically chase the winners and they buy high and they sell low. What is it that we should really be doing? We should be buying low and selling high. So when most investment advisors rebalance for their clients, they're taking them back to like some target allocation. They're really doing what we know we need to do, which is we're selling what's done well. Now we've got too much of it. We're bringing it back into allocation, and we're buying what's done poorly. That is such a simple thing to do, but it goes against everything in our sort of makeup. How hard is it to buy what's getting killed or what's doing poorly? That's hard. I mean, in our retail lives, when we walk into a store and we want to buy an item, we love a sale. But in the investment world, when something's been hurt, something's been knocked down, people want to run for the doors. And we need to train ourselves to be contrarians. Buffett is a famous value investor. Value investing, in many ways, is just thinking about being and learning how to be a contrarian. Again, going back to one of his famous quotes about being greedy when others are fearful and fearful only when others are greedy, that's about training oneself to be a contrarian. And this behavior gap notion, these sketches that I mentioned that Carl does, is one that is called the behavior gap, is the perfect example, because the returns that most investors get are way worse than what the market provides. Why? Because of bad behavior. Because we're not wired right. We're not wired to often make the best financial decisions for ourselves. So as markets go up, we go, oh my gosh, this is going to keep going forever, and we go buy some. Markets go down, we go, oh my gosh, this thing tanked, I got to get out of here. And that creates a poor investment result, and it's driven by bad behavior. So that's one of the simplest lessons, and like rebalancing is something very simple that investment advisors typically do for clients. It's really hard for us to do it on ourselves, even if we're like very knowledgeable. We have clients who are incredibly bright people, went to MBA, got their MBAs from the best business schools in the land, have lots and lots of money, rebalancing for themselves, meaning coming back to some target, selling what's done well and buying what's done poorly, is very difficult to do on yourself. So frankly, I think that's why there will continue to be a financial services industry for many years to come, because it's just hard for people, no matter your knowledge level, it's hard for people to sort of operate on themselves.
And you also remind me of the movie Wall Street, where Gordon Gekko says, don't ever get emotional about stock, it clouds the judgment.
Yes, but easier said than done. You know, as we sit here now in 2016, if you think back to 2008, oh man, I mean, emotion was king. And it's very easy when we're in sort of a sterile, calm environment to detach ourselves from our emotions. But if you log into an account and you see a value that's very different from what you expected to see, it can give you a very unsettling feeling. There's a guy who writes for the Wall Street Journal named Jason Zweig, who said when they studied the human brain and reaction to bad investment results, it triggers a part of the brain and a reaction that is similar to a snake bite. If you open up your statement and see a value that's lower than what you expected, the reaction is similar to what you would experience if you were bitten by a snake. It hurts us. This is incredibly emotional, because ultimately our money and our savings and our investments are tied to our goals and our dreams and the things we view for ourselves or our families, or causes that are important to us. Whether you want to give your money to your kids, or whether you want to give your money to charity, or create a better sort of retirement or life for yourself or your loved ones, it hurts us to see values that are less than what we're expecting or hoping for. And so it's, as humans, I think it's just, we're not wired to take that emotion out of the equation. And so figuring out ways that you can use the emotion to sort of, catapult yourself to a bigger, better, brighter future is really, really valuable. Or at least putting someone in between you and sort of those bad decisions. But that notion of the behavior gap, just sort of buying low, selling high, training oneself to be a contrarian, that's probably one of the most important lessons, and it's easy to understand. It's really hard to do in practice.
You also bring something up that I think would be important for our listeners to note, too, is a lot of times when you talk about how the brain does what it does, is that we also tend to act on the potential loss more than we do on the potential gain. So that being said, for instance, one of the big, I guess, eyesores when it comes to the story of Warren Buffett was that he never invested in Intel. And the reason for him not doing that is that he just didn't believe in investing in technology. He just, really didn't understand it that well. He always invested in things that he understood, which is another, I'm sure, goal that you share with your clients as well. But, the thing is that you're going to tell somebody that got to the level of wealth in this world, where he was the richest man on planet Earth at one time, that he's a poor investor because he didn't invest in Intel. And I find that funny, because a lot of times, and I'm sure you had this experience when you were with other brokerage firms, where they would pitch the idea to a degree that if you don't get in, you're about to lose something. Well, there's one guarantee in this particular equation, is you're about to lose your money one way or the other. It's going to go into my pocket. But the fact is that that's how people a lot of times act when it comes to investing, isn't it?
Mm-hmm. No doubt. And, I would say one big takeaway from my book that the early reader group comes away with, and people who work with my firm come away with, I would say, is the market is smart enough that it knows all available public information. If you and I wanted to buy Intel or any other company, what we would be saying if we thought we knew something that wasn't baked into the price is really that we have inside information, which is illegal, obviously. All the publicly known information is baked into the price of companies. There's a thing called efficient market theory, which basically is all about this concept of information being readily that is readily available and is public is baked into the price. So what people are saying really if they buy a stock is that they either know something the market doesn't know, or they're just hoping that things improve or that there are new products and new developments that create a higher price for the organization. And what we would say is it's so hard to pick individual companies. It's even hard to pick which countries will do well on an annual basis. We have a slide that's called the quilt slide, and if I showed it to you and I said, pick the pattern, it shows all the different countries and their and asset classes and their historical returns. There is no pattern. It's random. You can't predict which countries, which asset classes, which groups of stocks are going to do better. We can't predict which individual stocks are going to do well. So once you sort of acknowledge that the market is relatively efficient, it doesn't mean it's perfectly efficient. It doesn't mean there aren't exceptions or anomalies or opportunities for very savvy people to exploit something here or there. But it means it's efficient enough that it's hard to take advantage of it. It's hard to profit from it. So one of the things that we would say is don't play that game. Own it all. Own thousands and thousands of stocks. Don't worry about which individual company will do well. Don't worry about trying to time the market. No one has created a repeatable, reliable, robust system to outperform the market. If they had, we would know who that person is, we would know what their system is, and it would be repeated and copied by lots of other people. Over long periods of time, 8 out of the 10 people who are trying to beat the market don't do it. And the higher their fees, the less likely they are to even come close. So if you acknowledge that the market sort of knows information that's out there and it's really hard to predict, then what are you left to do? Well, you're left to sort of diversify, get a low-cost, tax-efficient, diversified exposure to global capitalism, to the world. And that's really easy to do. In this day and age, it's not hard to get that. And if you can be patient and disciplined, good things will happen.
You know, it's such an interesting world, you know, that people really should be doing their homework a lot more so they can at least have the language to understand what they're getting involved in. How often do you work with people in that realm to get them, I guess, up to speed, if you will?
Yeah, I would say, in my experience, most people just want to say, let's say for 2016 on their list of resolutions, they want to make smarter money decisions. This is the year they want to do something better than what they've done before. No one really spends a lot of time working on it. They'll meet someone, they'll say, Bob is a nice guy. I like Bob, and I'm going to put my money with him. Not knowing sort of what Bob's approach is, what the fees look like, what his historical returns look like, what is his process, Bob's process for making my sort of financial dreams a reality. Most people, even really smart, successful people, as I mentioned, people with lots of education, lots of wealth, if you ask them why did they choose the person that they chose, or how do they make financial decisions, or do they talk openly about money in their family and what it means to them, and what role they want money to play in their family. Most people don't talk about it, and most people don't have a system or a philosophy or a point of view. Unfortunately, I think most of the time, because the investment world feels like it's complex, that it ends up being purely a trust business, and people don't dig in. They don't ask questions. They think they might ask something that's stupid, or they just need to rely on the other party to make the smart decisions, and they'll go focus on what they do to create wealth. Unfortunately, that's why the industry doesn't have the greatest reputation, because there are lots of people who are just good salespeople, and they don't have any sort of system or process or logic or data or evidence behind what they're recommending. That's changing. The good news is that's changing. Over the last 20 years, firms like Vanguard and Dimensional Fund Advisors, firms like those are sort of changing the game. The last couple of years, the biggest inflows, new money coming into mutual funds, have gone into firms like Vanguard and Dimensional Fund Advisors, which are firms who sort of espouse the same sort of approach that I think makes the most sense for most investors.
Now, it's how you changed your philosophy about all this to where the client gets actually serviced and taken care of. which was opposite from what you were experiencing as you first started in this business. For people out there who may be listening to this and may be on your side of the fence as a profession, what would you say to them has been the greatest reward, if in fact there has been, using the philosophy and approach that you have as a professional?
Yeah, I would say as a professional, the thing that most people don't get to see is when this approach pays off and you get to see what it means for a real person's life. I have a client who was in my office and she started crying because she was so touched by what she was going to be able to do with the money she and her husband had amassed over a long period of time. And I said, "Oh, what are you going to do, and why are you so moved by it?" And she said, "Well, I'm going to pay off my sister's mortgage." And I said, "Oh my gosh, what a great thing that is." And I said, "But what makes you feel so emotional about this?" She said, I just keep thinking about what my mother would say if she were alive. This would make her happy." And that's the kind of thing, when you see the steady, plodding, the disciplined investor who gets to a place of real prosperity and who can make big things happen in their lives or the lives of people around them. I mean, that is just hugely rewarding. In the early days, when I saw what most of the financial services industry looked like, which was just salesmanship. It wasn't about the client. No one cared about the client. They were just selling product and trying to get the most commissions for themselves, and it was very disappointing. Those people didn't get to see this kind of thing because they were just sort of, pushing one product after another to create the most money for themselves. And there's that old saying, well, like, where are the customers' yachts? That was to poke fun at the fact that the industry and brokers were focused on themselves, and they had a very high self-orientation. Everything was about them and what they could do and what managing other people's money did for them. Well, thankfully, as time has gone on, there are fewer and fewer of those people, and a lot of people who are trying to do good things for real people. And I'd say the biggest takeaway for me is I used to be so in love with our firm's investment approach and having a philosophy driven by data and statistics. That we really, even in my own evolution, we weren't always the best listeners. We weren't always connecting or intersecting with where the approach could make a difference in a real person's life. And for me, the coolest thing is when you see an approach that allows people to stop paying attention to individual stocks. I have another client who showed me his iPhone one day, and he goes, "Look at this." He goes, "I used to every day stare at this thing and look at my stocks, and my mood would be affected by whether they were up or down." He goes, "Now I've erased them all. I don't look at it at all because I know over the long term I'm going to get market returns. I'm going to do very well. I'm going to meet my goals, and all I need to do is sort of ignore Wall Street and get on with my life." And I said, "Oh my gosh, that is so liberating, not just for them, but for us, because you've got people's now energy that used to be directed in a very inefficient, non-productive way, all moving in the right direction, focused on what's meaningful and important in their lives, and not focused on stuff that if they acted on the emotion, they acted on the anxiety, they would probably create an activity that wasn't productive for their long-term financial success anyway. So those kinds of things are really exciting. When you marry a strong investment philosophy with really good, smart people who know what's important in life, and then you have the advantage of helping them be disciplined and patient, good things happen. And it's not sexy, it's not fast, but we think it's the best path forward.
And then there was one more thing you forgot to mention. It's not rocket science either, is it?
No, it's not rocket science. It's not rocket science. It's actually, I'm a fan of this guy, Michael Pollan, who writes books on food. I don't know if you've ever read Independence
No, very,
of Food
very well, yes.
Yeah, so I love his stuff, and a lot of what he says about the food industry is true of my industry, too. It isn't that complex. Do you remember the book that he wrote where he says, "Eat food, mostly green stuff, not too much"?
Right.
I mean, that's a beautiful takeaway. Eat food, mostly green stuff, not too much. Mm-hmm. I think this in the investment world, it can be that simple. It can be that simple. It doesn't have to be so complicated. And our industry does a good job of making it seem so complicated because so many people have a hard time just admitting we don't know what the future looks like. None of us have a clear crystal ball. But once you admit that you don't know what the future looks like and you're going to have to make decisions based on what you do, none of us like complete ambiguity either. So we have to make decisions based on things that could potentially drive our future success. And I think academic research is the best thing to base future investment decisions on. It is an uncertain world, but the best we can do is study what risk and return have taught us in the past and take advantage of those things for the future.
And one more time, going back to investor Warren Buffett talking about simplicity, we actually had his former daughter-in-law on the program, Mary Buffett, who wrote a series of books based on his investment philosophy and strategy. And she says, when he gets into a company, there's a particular spread that he's looking for, and I think he had to hit a minimum of between 13 and 15%. So he had to wait for that stock, excuse me, to hit a particular price based on a calculation he used that would show that he would get that, and then that's when he would put his money into the company. That's sort of like that buy low, but then, he wouldn't sell because this was something that he would compound over time. And if you're going to tell somebody, well, I don't know if that's a wise strategy, and this is a guy that averaged, something like 24 to 27% every year for the last, I don't know how many decades, maybe that might be a right way to go.
My favorite thing that Buffett says is when he talks about the holding period, how long he wants to hold his investments. He says, my favorite holding period is forever. That's a great way to look at investing. If you're buying something and going to hold it forever, you're not speculating. You're an investor then. And from my perspective, just being disciplined, having a point of view and being disciplined, not just about sort of investing, but about not paying attention, because there's always going to be an apocalypse du jour, a thing that's happening in the world that could distract you or that could make you want to take some action that likely isn't productive. Activity doesn't always equal value. Selling something, buying something, when it's just reactive or impulsive or emotional, is rarely a great idea when it comes to investing. So, to the extent that you can have that same sort of Buffett attitude about my favorite holding period is forever, if you can really do that, your odds of success go up.
Mm-hmm. Now, Matt, is there a website people can go to find out more about your work and how to get a hold of the book, things like that?
Sure. I have a book website called matthallbook.com, matthallbook.com, or you can find it on Amazon and all the usual spots you would potentially buy a book. I wrote it with the idea that someone could read it in anywhere between 3 to 5 hours. I care deeply about, I've been giving away books to prospective clients and friends and centers of influence for 16 years. Most people wouldn't read the books that I gave them because they were boring finance books and highly technical. The only people who really loved what I would give them were highly technical folks. So I wrote this because I wanted to reach a broader audience, and if you go to matthallbook.com, you can read more about it.
Well, very good. I know that I've read and interviewed many people like yourself, and certainly the listener out there would be wise to pick this up, because the big thing we're trying to talk about here today is really changing your view and your thinking about this world of financial investing, and then knowing how to begin to, as you talk about, set up personal goals and individual strategies, and most importantly, when you go to somebody who, like yourself, be sure they're listening to what it is that you want, instead of having them sit there wondering what they're going to get out of this whole thing.
Mm-hmm. Well, just thinking and talking about what money does for you, what you want it to do for you, what your approach is a step in the right direction. For some reason in our culture, it's been a very taboo subject, so oftentimes people would rather talk about politics or sex or religion before they'll talk about money. And maybe that's because our parents didn't talk to us about money, or we either think we don't have enough, or we have too much and we don't want people to know, or whatever it is that keeps us from talking about it. Just bringing to the forefront in your family or in your relationship what it means to you, what it can do for you, and what your philosophy or approach is about how to make the most of it is a step in the right direction.
Well, very good. Matt, thank you so much for joining us here on the Beyond 50 radio program. And again, your website is matthallbook.com.
Book.com.
Very good.
Yep.
Matt, thank you for joining us here on the Beyond 50 radio program.
Thank you. It was my pleasure. Enjoyed it.
You bet. We want to thank you, the listeners out there. You can also discover more by visiting us at beyond50radio.com. That is the number 50. Sign up for our weekly e-newsletter as well. Stay up to date on what's going on with the radio program. You can also visit us at Beyond 50 at Twitter as well as Facebook. I'm Daniel Davis. Thank you for joining us. This is the Beyond 50 radio program. And remember, live your day past halfway.